Okay, today on the show, we've got a super special treat for everyone. We have our good friend, Marty Smith from Security Mutual Life of New York. Now, Marty was on the show before in 2021 and shared his story. We recommend going back to see that episode. But today we're going to get into a very unique and awesome way to use the bank on yourself concept through one of the types of riders that is offered by Security Mutual Life. We're going to get a little technical. We're going to tell some stories. Hope you really enjoy this one. If you're listening on the podcast, this is one to definitely listen, but then go over to YouTube to see the numbers when we get to that part. We'll make sure we get the link to you in the show notes here. If you're watching on YouTube, thank you so much for being here and helping us grow on this platform. We definitely know, if you're like me, that lots of people are visual learners, and we really are glad that you're here and watching and seeing what we have to share that way too. If we haven't met before, I'm Amanda. My husband and I, Brandon, him and I run this channel, and it is a labor of love. We love doing this. We also love hearing from you. So please, on the YouTube version, the comments are open. We'd love to, even if it's just a hi, a thumbs up to this video, of course, subscribe to the channel, all those things that really fuels what we do. It gives us some encouragement as we go, and also helps the algorithm and have more people share and see this awesome content that we hope and brings hope and inspiration to you. So before I forget, welcome to the Wealth Wisdom Financial Podcast. We believe when conventional financial thinking doesn't get you where you want to go, you need wealth wisdom. Thanks so much for being here, and I can't wait for you to meet Marty or meet him again if you've been listening since 2021, and I think you'll really get a lot out of today's episode. Without further ado, here's Marty. Okay, it's been way too long. Marty, you were first on our podcast back in June of 2021. So it's been way too long. We've talked a lot between then and now, but no one's gotten to hear your voice on our podcast. So welcome back. So glad that you're here.
Well, thanks so much, Amanda. I really appreciate that. And I look forward to speaking again today with you.
Yeah.
And Brandon.
So we shared your story and where you came from, how you first heard about capitalized whole life and all of that back in that previous episode. Over the last few years, how have things been going? What have you been noticing? What's changed before we dig into the exciting stuff we have to talk about today?
Well, I think that the industry is more and more people are moving towards the bank on yourself, become your own banker philosophy. And I think that is a tremendous advantage that not only agents have, but for consumers. This is all about everything about bank on yourself and becoming your own banker. The infinite banking concept is for the consumer. It's for the layperson. The books are written not for agents. They're written for people who will actually use their dividend paying cash value whole life insurance policies for the maximum effect that it can create. And boy, does it have a real wonderful way of doing that.
Yeah. And that's exactly what we're going to talk about today, is how do we use them to their maximum benefit? And I know you're going to school me a little bit, which I'm looking forward to. And we're going to talk about one of the most unique and specially designed versions of capitalized whole life, or how we use the bank on yourself type whole life policies. But for the person that maybe is just first coming to this, what does typical whole life look like? What's the kind of ordinary design?
In the past, dividend paying whole life insurance was I would say it was the difficult sale. It was difficult in the sense that there was a premium that was stated. This is what you pay for this particular death benefit. It took years for dividends to be credited to the policy, or dividends would be very small in the beginning as the death benefit would be prepared in order to make it grow. But that's changed now. And that's changed because certain people in our industry were able to look at it and say, well, wait a second. I bet you there is a better way that we can design these policies and design them so that they'll build cash value almost immediately. And the wonderful thing about that is not only does it build cash value immediately, but you'll have access to that cash right away. And that is what is so exciting about these policies and the concept that we'll talk about a little bit more.
Yeah. So how do we
So
do that? Or sorry, go ahead,
well,
Brandon.
I was gonna say, like, so you've probably been around here for a little while, and you probably met the guy who kind of thought about this, the infinite banking concept, Nelson Nash, and then you're kind of I would say, inside man with one of the companies, right? Security Mutual. So did you learn that and say, hey, what do we need to do at Security Mutual to do this? And have you been able to influence over the course of some years the change into development of these kind of products? Have you been like, hey, that's really cool. How come we're not doing this? And how can we do
It's,
that?
well, Brandon, that's almost exactly what happened. I believe that somehow the unseen hand of the divine pushed me in my own thinking and made me suffer with how does money really work? That was the question that kept coming up in my mind. And lots of sleepless nights led me down the path to somehow I got to Security Mutual Life Insurance Company. Once that happened, I was introduced almost serendipitously to Nelson Nash, who was the author of Becoming Your Own Banker and really the creator of the bank on yourself, the Becoming Your Own Banker concept. I read Nelson's book over and over again, and I realized when I literally from the time I met him to the time I got back home, I must have read the book 3 times. And when I got back home, my wife said to me, what's going on? You seem different. And I said, I am different. I think I finally found what I'm looking for. So immediately what I did was I contacted the company, and actually the chairman of the board gave me a call and said, hey, Marty, what'd you think about this thing you went to this past weekend? I said, this is something that Security Mutual has to do. And this was over 15 years ago. And literally what happened, Nelson was having his big meeting in Birmingham, Alabama, and I got several senior vice presidents to join me to go to that meeting. And that's where Security Mutual said, this is a perfect fit for us and what we do, what we believe in that whole life insurance, in the fixed products there, looking for certainty, guarantees, and security. It was the perfect match. And frankly, after all these years, I am the champion of infinite banking, becoming your own banker, bank on yourself, circle of wealth, those kinds of concepts that use the concept of having your whole life insurance policy being the financing device in your life. It worked out perfectly for Security Mutual, and Security Mutual has just been building and building with more and more clients, more and more policies, more policy owners who latch onto this concept, love it, and use it in terms of being able to access money to finance their life, make major capital purchases. So it's just been great. It's just been great.
Well, and that leads into I think what we want to talk about today is one of our favorite products. As we've been doing this for years, we were not even thinking about 15 years ago, this whole concept you were, and we kind of jumped into the scene later, and
Sure.
we found, we have different companies that we work with, and they're all great, but one of our favorite products is the Combo Writer, and we've used it. We have multiple of them ourselves, and we educate clients on that. So this video today is going to be deep dive into the combo writer. So that way people can say, hey, this is a really cool, I mean, for life insurance, how can you have a really cool product that can do amazing stuff? Well, we're going to show you today. So
That's fantastic there.
I'm
That's
curious, Marty, has the combo writer always existed? Do you know when it was created or how it's changed over the years? We know how it
well,
is today, but
well, the wonderful thing about the life insurance companies is sometimes they actually look and see what their holders want to buy and what the policyholder actually needs. As I was saying before, in the past, there was very little flexibility in the whole life contract. In fact, if you were a business owner, you would resist buying whole life because of the demand to pay that same premium year after year. If you didn't have the accounts receivable coming in order to do that, you would hesitate to want to purchase that type of product. So we realized that we needed to create a whole life that had what? Flexibility. Oh, imagine that. We needed to create something that would allow the policyholder to have flexibility in terms of how much they paid in premium, when they paid their premium. It just was a natural thing to create, and it's turned out to be one of the best things that the company has ever created, particularly for the clients who really were demanding that kind of flexibility in their life insurance. So
yeah.
that's what we did.
Yeah. And so business owners, real estate investors, maybe somebody that's expecting a windfall that isn't here yet, they want to be able to put in more, or maybe somebody that has, maybe they're retiring in 5 years or like going to part-time in 5 years, like doing a staged retirement. There's so many people need and want flexibility.
People who receive bonuses,
Yeah. Ooh, good one.
sales commission people, any executive who expects additional monies to come in. And that is what the combo writer is all about. It's
Yeah.
all about creating the space to store your money in this wonderful, unique wrapper that dividend paying cash value whole life insurance really is.
Yeah. So we've got the base of the whole life policy. It doesn't exist without a contract, right? That's the base. And then we add this rider, what they call the combo rider. What is the combo rider? Like, let's talk in a little bit of insurance speak, and then we can translate it a little bit.
Sure. The combo rider is a combination of term insurance and paid up additions. So what that really means is normally when a person has a whole life insurance policy, they select a base premium that they know that they're going to pay year after year. All right, that's done. That has its own death benefit. The combo rider allows additional death benefit in the form of term insurance to be added to the policy. But the unique aspect of that is it also allows paid up additions to be paid along with the term insurance. And in effect, what happens is over time, each paid up addition from the combo rider transforms a portion of the term insurance of the combo rider term insurance into permanent paid up additions death benefit. Oh, well, what's that, Marty? Well, paid up additions death benefit is something that you can have. Normally in the old policy, you would have different dividend options. The best and the most used option is dividends that buy paid up additions. What are paid up additions? Those paid up additions buy additional death benefits. Not only do they buy additional death benefits, they create their own cash values. Oh, not only do they create their own cash values, they create their own set of dividends just for themselves in addition to the base policy premium that's there. So it's this, people say, oh man, that whole life insurance is that black box. You don't really see what's going on. Well, you don't really see what's going on, but you know what's going on. The monies that go in there are always creating instantaneous cash value for you. And that's what builds the contract. That's what builds the death benefit. That's what increases dividends. It's just a wonderful wrapper that you're able to store your money in.
That's enough technical talk for me. You've got
Me
some
too.
really great questions that you asked to help determine if and how a combo writer works for folks, determine if they should have one or if they want one and how it should look for them. One of those questions is, how much premium flexibility do you want? How flexible can these things really be?
It's imagine this. The minimum thing that you have to do for the combo rider is pay the term insurance portion of the combo rider. Once that term insurance is paid, and that normally comes out of the combo rider paid up additions premium, it's how should I say this? It's like you put in money day one, you're able to access money or the cash value that exists day two. You want to put in additional monies into the combo rider, you can do that. Normally in the past, you'd have to wait till the policy anniversary. With the combo rider, you can put in additional monies anytime up to what we call the modified endowment contract limit, the MEC limit, we call that, anytime between day 2 and day 365 of the policy year. So what happens is, just to be a little more technical, the combo rider, the death benefit is created by the base premium. The combo rider adds an additional death benefit. The total death benefit of the base policy and the combo rider term creates the total face amount. The total face amount creates the MEC limit. That is the number of the maximum premium that can be placed into a policy. So let's say you put in let's say your MEC premium was $100,000. Well, you could put in the base plus the minimum combo rider term premium, and that would probably, depending on your age, let's say that was, you put in, $3,000 into the combo rider. Well, that means anytime between day 2 and day 365, you could put in an additional $97,000 into the contract without creating a MEC. You don't want to create a MEC because you want things to have the tax advantages that life insurance provides. And that's the reason that you don't want to go over the MEC limit. You want to be under it there or right on it. That's the way that works.
Yeah. Okay, so we've got we set up a floor and we set up a ceiling, and we can go anywhere between those in terms of how much we put in. How much premium should we want to put in? What should we think of as, what's our ceiling?
Well, your ceiling would be, there's a way to determine that ceiling, and that's going to be, because this is a life insurance contract, you need to be underwritten. So there's 2 real main components when you have a life insurance contract. The first is your health. How are you in terms of your physical health? And the underwriters look at that. That's why we may want to draw some blood, take some urine, have an examination, find out your medical records from your doctors, find out what prescriptions you take. So that's matter of course. And all that's going to do is put you in a category, whether you're standard, preferred, or best class, or if you smoke, whether you're a standard smoker or less than standard, right? The other aspect of this is the financial underwriting. So you have to qualify both medically and both financially. So what do the underwriters do? Well, the underwriters take a look at what you claim as income. What is your net worth? What do you own? What has been your cash flow in the past few years? Where does the money come from? So they are going to really look at all those financial aspects of your life. And then what they'll do is they'll determine how much life insurance that the company is willing to give you along those lines. That obviously you have to pay for. So that's how that works.
One of the things I like on ours anyway is that flexibility, of course, and knowing as I started my combo writer, I think it's been over 5 years now. We had some ups and downs. There was this whole thing called COVID that happened.
Oh yeah,
And
that.
we were able to,
Yes.
we were able
Yes.
to lower our premium, and then things have shifted and been able to increase that, which has been amazing as business owners, and same in real estate. And also knowing that the interest rate on what is it, the Fed raising their interest rates, that affects things in Wall Street and in real estate. And so being able to have some stability in that regard, also using our policy to save for taxes, just a place to leverage and use. So I think Amanda has some examples or something where we're going to show, hey, there's some worst case scenarios, COVID, that sucks. No one wants to go through that again. And business, everything halted. And we're like, oh, well, what do we do? Like, we have no money or something. And then the flip side is, oh man, we're flush with cash. How do we make sure we are keeping it and not just spending like drunken sailors, and leverage and using it wisely, because the banks will make money either way. So yeah, Amanda, I know you have some illustrations that we want to talk through together.
Yeah, I've got some numbers. You ready to go there, Marty? Anything else you
Sure.
wanted to talk about? Okay, here we go. So I'm going to share my screen here. We're going to talk through this. So this is Aaron, real client, giving me permission to share these numbers. And Aaron started this policy a few years ago. And he had 40,000 just sitting in a bank doing nothing. But his company was a little uncertain at the time. He is a business owner. So I originally showed him this first set of numbers where he could go down to just the base only, cover a little bit of, the cost of the term. And then, maybe the business does better the next year, he can go put in that 40. Then all of a sudden, let's say he gets a big windfall. He has a great year in business. He sells a part of his business, something like that, how high he could potentially go. And, then steady as she goes here. And then he wanted to retire at 55. So I wanted to show him, okay, now you could be totally done. You don't have to put anything more in. This is the numbers we started with. He was a little confused about the combo writer and how it worked. He's like, well, I can go down. What if I stayed down? Well, I could go up. What if I stayed up? Like, what? Teach me, Amanda, how does this really work? And so we went under the hood just a little bit. And I took the same exact policy. You'll notice in each of these scenarios, it's the same premium going in, the same cash value, and the same death benefit. And this third one is also the same. It just has a larger premium the first year. So you got a little bit more dividends that first year. That's why the death benefit's a little higher. And what you'll notice is this year, let's say business goes horrible for a really long time, he can only pay the base. He still maintains a really good death benefit. It does go down because he's not covering the cost of the term. The term is a 1-year term that renews, can increase. But even then, this is kind of more like your traditional whole life where it's now going to be only base. But look how much his cash value is still growing with all the dividends he's getting and the guaranteed increase of that cash value. Even though like he only put in extra into the combo writer that first year. And I didn't want him to do this, but this was his worst case scenario.
I like showing the worst case scenario because that just shows you that, at a certain point, if you don't pay for the combo rider, it will disappear from your policy.
Yeah.
That's why it's so important to make sure you always work with the home office staff to see what the minimum combo rider term premium is if you fall in that kind of circumstance. But yes, you're right. You put in 11,000 and down the road, what? It grows more than 11,000. So hold it. What would Nelson Nash say about that? Nelson Nash, people would ask him, well, Nelson, how much does whole life insurance really cost? And Nelson would always say, nothing. What? Like, what do you mean nothing? Oh, it happens that there's a certain time that you'll see in this contract here, when you look at the increase in cash value, when you pay your premium, all of that $11,216 shows up as what? Oh, it shows up immediately as cash value in your policy. Where does that happen? Well, that happens in one of those middle years there, 6, 7, 8, something like that. You put in 11,216 and there it is. Wow. And then it goes, and then of course, what happens after that, because of dividends, it continues to grow even higher. That's phenomenal. That's
Yeah.
phenomenal.
Yeah.
The other thing I wanted to ask you about, Amanda, is in year 10 on the first column there, where you show putting in the 40,000, you show putting in $111,216 as pay that as premium. That is pretty amazing.
Yeah.
That is pretty amazing.
Flexibility, right?
Oh,
How are we able
yeah.
to do that, Marty?
Oh, yeah. That's what the compo writer's designed to do. In fact, depending on what the MEC premium is in this policy, you could that 40,000 doesn't have to be the same. Obviously, if you look at this, it's like, oh yeah, I'd love to be able to put in 40,000 all those years. That'd be great. That's fantastic there. But with the combo rider, you could put in year 3, 12,000. In year 4, you could put in 20,000. In year 5, you could put in 45,000. You could put in more than 40. In fact, I'm sure because of what the MEC premium is, you probably could have put in close to $250,000 into that policy.
Yep.
If the client had the cash flow, if it was sitting idle in a bank account. And frankly, it probably should be put into the policy because again, what do you want to do with your policy? You just don't want to keep putting money into the policy for no reason. You want to use this policy. You want to use this in order to purchase the things that you need in life. Major capital purchases, your cars, your pay for education. If you're a business owner, you want to pay for your business equipment, for your inventory. You could pay your taxes with it. You could pay salary with it. Again, the point about putting money into the whole life contract is that money is transformed into cash value. The cash value grows tax deferred. You're able to access that tax deferred cash value without having to pay any taxes. That is one of the best advantages of the dividend paying cash value whole life insurance policy. And have I not said it yet? That cash value dividend paying whole life insurance is the best financial product that's ever been created? Without a doubt, it is the best financial product ever been created. In fact, take a look at that $111,000. What was the cash value the year before? 319,000.
Yep.
You put in 111, and what did your cash value grow to immediately?
442, 123,000 more.
That's more than 111,000.
Yeah.
I mean, where do you find these things?
Yeah.
Here's the thing I like to think about is when people ask me about, putting in 40,000 and they say, well, I could just save it. And I like to say, okay, you could save it. Okay, so 40,000, there is a cost of insurance, right? And so I can look and say 40,000, you have 25,847, right? So that's a difference of like 12 or 13,000, somewhere in there. And you have a death benefit of $3 million. So it costs you $13,000 to have a $3 million asset. Now, if you could put in 40,000, like a house, and have access to 25,000 to get a $3 million house, would you buy that house?
Wow.
People say
of the week,
all
right?
day, every day. Yeah,
Yeah.
I would do that every day of the week.
Right.
So I just like to say, well, here's the thing. Your savings account isn't going to give you a death benefit. And this is long-term thinking, thinking about, legacy planning too. Hopefully you have to die to get this, but you're taking care of your family, but you're the house, you are the asset. So and it's tax-free. why wouldn't you buy that house? Right. And so thinking strategically, and then knowing this guy is 36 years old. I don't know about you, but I know my income potential tends to grow as I get older, and usually in the 50s is whenever it's pretty good. So I'm pretty sure he's gonna be in a really good spot because he's only 36, right?
Well, let's go
So
back to
that's something
Aaron.
I thought
Can
about.
I go back to
Yeah,
Aaron? So,
Sure.
yeah,
um, Aaron wanted to retire though at 55. He wants to sell his business, not be working. He's kind of part of the FIRE movement, the financial independence, retire early. He doesn't have some big extravagant lifestyle. But he wants independence. He wants freedom. So what I loved was in this third example where we're showing loans and repayments, he had about a $40,000+ tax bill every year because he'd been so successful in growing his business and selling lots of products and doing lots of things. So we talked about he could take that 40 that he was currently saving for his tax bill, put it into the policy like we showed in these other ones, but he's also going to want to save more to pay his taxes later. So then he could keep saving in the policy, like adding that money that he was going to eventually send to the Internal Revenue Service anyway, and he could get 60,000 in the first year. And then unfortunately our loan, the illustration software that we use doesn't show loans in the first year, but immediately he could take a loan if he wanted to. Just our software requires us to show it in the year 2. So I'd put it in year 2. And now this is him paying his taxes or maybe buying inventory to reduce his tax bill. Who knows what he's going to use this money for, but let's say it's pay taxes. You'll notice like he ends up doing that every year. He's putting in 60,000, he's taking 48 out to pay taxes. So it's basically like putting 12,000 into it that he's not touching. Kind of like we were doing over here. It's just a little less than $800 more. And you'll notice he builds up a huge loan balance over those first 10 years. $500,000 of loans. Why would anyone ever do that? Like we're told, be scared of debt. You don't want debt. Well, it's a super low interest being charged on policy loans. It's simple interest. It's factored a lot differently. But then also look what happens. His death benefit, this is factoring in loans, right? His death benefit stays high. He then keeps putting in 60, but only he's converted all the term to paid up additions in that combo writer. So this year 11, he can only put in 32,000 and some change to premium. The rest is going to go to loan repayment. And then year 12, he's only able to put that base, that 11,216, because all the term is gone. He's all paid up additions in the combo writer. And he's able to put the other, the 48,000 and change back to the loan. And then he keeps doing that going forward. So you see how quickly the loan goes down, even though he's still paying interest on that loan. And then look out here, let's say he continues doing that. Maybe he sells the business and he pays everything off, more quickly. But I wanted to show him, let's say, we stay even Steven. He's still got that loan fully paid off before he's 64. And look at how much more death benefit and cash value he has. $2 million that he gets to use for the next 30+ years of his life versus over here, 478. And protecting his family was 4.4 million instead of 1.1 million. And even in these scenarios, right, where he was doing a little bit of funding, retiring early, we still beat that out, even though he built up a $500,000 loan balance. Now, so this was kind of a little bit of let's take the worst case scenario and let's play the same thing out, but with loans, right? Maximizing the loan capability almost, right? He still has plenty of cash value here for emergency funds, just, in case his tax bill ends up being more than it was, could have been, those kind of things. But what's great is, like Brandon was saying, he started this when he was 35. His business actually did super well during the pandemic. So he's not only been able to keep going with the 60,000, he's been able to already start repaying some of the policy loans, doing some phenomenal things. And he's right on track to see this actually be better than what, this is like the middle one is the worst case. This is like the second worst case of what he might do. Marty, what's your reaction here?
I love it. And the reason is, let me ask you a question. When Aaron goes to the life insurance company and says he wants 48,000, what's the one question that the life insurance customer service people are going to ask him?
Well, it's pretty much, do you want it a check or an electronic transfer?
That's what they ask. They don't care what you're going to do with the money. All they want to do is, if you've been paying this your premiums uh electronically, EFT, they're going to say, well, what's your we can just put it right in your bank account today. Would that be preferable for you? Oh yeah, that I think that'd work out. The company doesn't care what you do with their money. With your money here, they're going to do it. The other thing that I want people to understand is this 48,000, is this coming out of Aaron's policy or is it from another source?
It's a really good point, Marty. It's coming from the general fund of the life insurance company.
It's coming from the life insurance company. When the bank loans you money, whose money are they lending to you? Are they loaning the bank's money? No, they're loaning you. They're loaning you everybody else's money. They use other people's money in order to make money. When you become your own banker, in effect, what you do is you're using whose money? Other people's money, OPM. In this case, it's the life insurance company's money that you're using in order to grow your business, grow, pay for whatever you want to do, live your life, finance it the way you're going to do in the manner that you want to do it there. So that's the beauty of becoming your own banker. You're using other people's money. Your money never leaves the policy. Your cash value is growing. Your death benefit continues to grow. The life insurance company just has to show you in case, oh, well, what happens if I die? Oh, well, if you die, well, this is what the illustration would look like. We're going to subtract out the loan principal that you owe, and we're going to subtract out any loan interest. If you want to surrender the policy, which you'd be crazy to want to do, in most cases, whatever, this is what the cash value that still exists in the policy. When you look at Aaron's illustration there, you're showing that the death benefit looks like with the loan. Oh, how much is that death benefit? Oh, it's like almost $3 million the whole time. It's like, wow, is my family in a better financial position with the leverage of dividend paying cash value whole life insurance? Well, of course it is. That's what this is about. Does the bank give you leverage to your money when you put it in the bank? No, it's only worth what the bank account is. If you buy stocks, bonds, mutual funds, what's that? Do they use leverage? No, it's only worth what the market bears at that point in time. In your retirement fund or 401k, where do you want to store your money? How much is that money worth? Well, there's no death benefit associated with that. It's just what the account value is at that time. What is your real estate worth that you purchased? You never know. You never know. My mother sold her house at the top of the market, bought a new house at the top of the market. I mean, she's 81 years old, because I'm not going to replace that roof one more time. I'm not going to do it. Okay, Ma, that's fine. But when we went to sell that house 10 years later after she died, we had, because of market conditions, we had a 40%, not 40,000, a 40% reduction in what we got for that house. And I kept saying to my sisters who were saying like, oh, this is going to be, I said, no, the house is only worth what somebody's willing to pay for it.
Yep.
You know what your combo rider whole life insurance policy is worth? Well, it's worth what the base policy is. It's worth what the combo rider term still is, and it's worth what the paid up additions death benefit is. And it continues to grow constantly. Even after you paid off the combo rider, that death benefit is going to continue to grow because of what? Well, because of the dividends that are taking place inside that policy, both from the base policy and both from the permanent paid up additions death benefit there. Wow.
Yeah. And I can tell you, Aaron was the primary breadwinner for his family. He had taken a lot of risk to go into business on his own and leave, a W-2. And he had a young child. Like, this helped him sleep better at night. It wasn't just about how much is this cash value growing. It was about like, I know that even if my business goes to zero, I've got this that I can lean on, and I'm protecting my family in case I go to zero, right? Like, and
Right.
thankfully he's doing super well today, and I'm excited that he will be for 30 plus years, 60 years. But that not it's a lot of people talk about dollars, cents, right? How much are things growing? What does it look like? But ultimately it comes down to, do you sleep well at night? And any kind of financial strategy has to do that. And I've never found anything that helps me sleep better than dividend paying
But
high cash value whole life insurance, especially for people that are taking a lot of risk in real estate or in their own
Yes.
business. It really like counterbalances those things because you can count on it no matter what happens.
That's
what,
why
what I
we
like about
oh,
this
go ahead.
is it's not an investment. It is a savings vehicle that we're just being smart using. When people like Dave Ramsey says it's a horrible investment, I'm like, this is where we put our liquidity savings to be able to leverage and to be smart with the cash value, right? You could go to Vegas and take a loan, like you just said, and go to Vegas and lose it or win it. I don't know. I wouldn't recommend that, but or you could use it when markets are crazy, right? So what's interesting and why I think there's a lot of traction here is the interest rates in real estate is high, right? So I know if I used my policy cash value, the interest rates are different, calculated differently, and I can have a lot more control, which I'm a business owner. I like control. Real estate people like control too, right? I think. And I've been able to use my policy personally to buy an office condo. It's the and asset for a reason to be able to then have the business then pay me rent. And because I had access to capital, I was in control and having a business, but also being in the game of other areas. And the combo writer has just been a backbone for
Yeah.
us personally, and just teaching other people on that is like, yeah, how do you do that? If with the worst case scenario that I've been seeing is as I've been working with clients, they're like, thinking too small, and they come back to me later and say, I wish I would have made a bigger policy. I've had
Right.
that happen multiple times, not the other way around.
That's why they're going to own more than one policy. Nelson Nash owned 45 policies the first time I met him there. He owned it on himself, on his wonderful spouse, on his adult children, on his grandchildren. And because he was such an entrepreneur, he owned it on every business partner he had. It's just, again, becoming your own banker, banking on yourself. You don't need to be the insured in the policy, but if you have policies that of people that you have insurable interest in, that's how that also works. The wonderful thing about whole life is it's the safety, it's the certainty, it's the security that it provides, not only financially but psychologically for yourself. And that's the thing that needs to be embraced. That's the thing that your clients, especially your clients with families, they need to understand that the both spouses need to protect each other, and there's no better way with the flexibility that's offered with the combo rider. It's, again, if you're talking about Aaron's policy, there's a base policy that has a face amount. So, but so that, let's say that's the value of his house. But when you add on the combo rider term death benefit, it's like, whoa, wait a second. I now have a $3 million house, as what we were saying before. And the wonderful thing with the combo rider is when you pay additional premiums, it's like putting on additions to that house. You don't have a house anymore. You've got a mansion. You see the mansion with the combo rider, and all you're doing is filling in the rooms, the mansion in the sky there that you've actually built. And when that combo rider death benefit has been transformed from 100% term to 100% paid up additions death benefit, that has been the dream of my life, to have guaranteed insurance for people that you just can't get rid of. That That's like an anchor there. You'll never get rid of it. And because you don't have to pay for it anymore. It's already been paid. This is paid up death benefits there. You don't pay any premiums anymore into it. And that's too bad, because the one thing about life insurance is your money has to go somewhere. You need a storage space for it.
Yeah.
If dividend paying cash value life insurance isn't the best money storage system that's ever been created, unfortunately, some of the financial celebrities out there just haven't been able to make the connection and realize all the advantages. If you put different financial products side by side and say, well, what product has creditor protection? Ooh, a bank account? No. But life insurance, oh yeah, practically everywhere. All the different things that you can look at and compare side by side, you're going to find that the best money storage system ever created is your dividend paying cash value whole life insurance.
And it matters who you have that policy with. And I have to say, I am so proud to introduce people to Security Mutual Life. We have got several companies we can work with, but when I get to talk about the company that cares, that actually cares about their clients, about ending cancer through the Sock Out Cancer Initiative, has a tremendous diversity, equity, inclusion program, doing real good work, not just in your community, but across the United States. I'm really proud of that. And then to add on to that, the history, they haven't just been doing this for 5, 10, 15 years. The Security Mutual was created in 1886, been paying dividends for 135, 136 years now, every single year. That's, I can't think of a dividend paying stock that's even gone back half that time that's paid dividends every single quarter.
Right.
Like,
and that's again what you want to build your foundation on. We are about building foundational wealth. This is again, we are business owners. We do risk a lot in the business, but building a good foundation. This is why the world is kind of crazy, because we built upside down pyramids.
Yeah.
And we want to build a solid foundation and help others, especially in this real estate world. So as we drop this episode, people are still wanting to do a lot of real estate, right? And they're like, oh yes, but the banks are charging me this, and the cap and spread is very different than it was 3 years ago. And it's just interesting to be able to use this as a place to store your savings while you're gonna do a flip, or you're gonna do something, you're gonna leverage or use it. It's just a way to think smart about your your foundational assets.
Why do you want to own a whole life insurance? Because you want liquidity, use, and control of your money. That's what whole life provides: liquidity, use, and control. It's been around over 150 years. Security Mutual, as you said, I think this November, it's the 138th year of its existence. It's paid dividends consecutively for the past 132 years through every war, recession, depression, downturn. But that's the wonderful thing about the life insurance companies themselves. And there are a lot of great life insurance companies out there. I have a lot of the other companies you do business with. I'm very good friends with the people who are my counterparts there.
But I do think,
and they have their strengths. Well, they have their strengths, and the flexibility of the combo writer is a huge strength. One of the biggest gems in the crown at Security Mutual.
Yes.
We love it. We love introducing people to it. It really changes financial future. So keep making sure they keep it on the list there and continue to improve it too.
Very good.
Well, and I do love that the people that work there, most of them have been there for almost 130 years.
No.
I think Dan's
that's
been there
why we like to take those company
inception.
pictures, Brandon. That's it. That's
although
I'm a New Yorker.
I'm
I'm a prisoner in New York City here. We have a regional office, and that's where I live. So that's how it works. So.
Well, thank you
Cool.
so much for your time, Marty. I really appreciate you sharing how you think about the combo writer with our audience. And thanks for not going too hard on me with my illustration, my numbers and that we were looking at. One of the things about Aaron's policy, I looked it up. His MEC premium, the most he can put in without making the policy taxable, is about 90,000.
Oh, wow.
So he's
Oh,
got
wow.
a lot more room to keep going with the numbers. If you could say one thing to the Aarons of the world, people that have these combo writers or are thinking about getting one, what would you say?
The best place to store your money, the safest place to store your money, the best place that it's ever going to do to create leverage for your family so that you can sleep at night and enjoy life is making sure that the base of your pyramid has that dividend paying cash value whole life insurance policy. The combo rider, that is where you're going to store your money. That's where you're going to get access to it. That's how you're going to finance your life, your kids' education, potentially retirement. When I saw that $2 million down the road at age 65, that's $100,000 tax-free tax-free income for
Right.
the rest of your life. That's it.
Yeah.
We love tax-free. Tax-free is good. So
Awesome. Way to go with the mic
We
drop
haven't even
moment
gone
there,
into that,
Marty.
so.
okay, very good.
Well, thanks
Amanda,
for being
thank
here.
you so much.
Thank you.
Brandon,
You
thank
guys
you.
don't forget to subscribe, like, reach out to Marty Smith at Security Mutual. Yeah, we love it. Any closing remarks you want to say, Amanda? Besides like, subscribe, write a comment here. Marty will look at the videos. I mean, I'm sure he will. You can write a comment and we'll send it to him.
We close every podcast by saying live long and profit. The longer we're able to have these types of policies, the longer we live, the more benefits we get and the more we can profit from the security and the stability of awesome companies like Security Mutual. So keep taking care of yourselves, everyone, and we'll catch you next time on the Wealth Wisdom Financial Podcast. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.